But the market doing absolutely a great 70 points, 17,555 is what we have. Rahul Arora is CEO at Nirmal Bang Institutional Equities, and he's with us here in our studios. Rahul, great to have you with us here on the program. Thank you for dropping by.
Thank you for having me. It's been a while.
How are things? How is business? How are the markets looking? I mean, and how are you thinking about the entire sort of setup from here?
So it's a two-part question, Prashant. I think as far as business is concerned, I think that period from mid-May to mid-July was very bad. And I think you would have seen that in the Q1 results of most broking firms that are listed. It's picked up since then. So it's not been bad. I think Q2 sequentially should be a reasonably good quarter for business as well as for the broking industry at large. Deals have come back in a fairly material way. Markets, Prashant, I think it's going to be a very tough year. I think if you're looking at this Diwali to next, I think it's going to be...
What's left of it? Or are you talking about 23?
Sorry, Diwali to Diwali.
Okay.
I think it's going to be very tough to make money. I think we're obviously going to be heading into a slowdown, in some cases even a recessionary environment. So I think the ease with which money has been made from a 7,500 Nifty to an 18,500 Nifty, I think stock picking is going to be extremely critical. I don't think it's going to be a year for a blanket top-down approach. I think you'll have to be very selective. But I still don't think there is enough evidence to help us break above 18.5. Concurrently, I think, a few months back when crude was at 125, 130, the Nifty had dropped down to 15. So I think that's probably a slightly wide range, but I wouldn't be surprised if we spend the better part of the next calendar as well in a range of 15 to about 18.5. There'll be money-making ideas, but it'll be very difficult, is my sense.
Okay, and that's why we have you here, right? Stock picking is going to be crucial. There are money-making ideas. I think Diwali is a time when we anchors legitimately can ask, the experts for ideas. So tell us, what are the Diwali picks for you? I mean, what is something that, even if you don't want to talk about individual stocks, what are the big themes that you think could work from this Diwali to next?
So, I don't know how big of an expert all of us are going to be to predict next year, to be very honest. But I think, Sonia, one thing is for clear. I think I'll probably stay away from export-related stocks, which includes IT as the biggest sort of stay-away factor from, even though it's underperformed. I think it'll probably be more domestic, and I think our pecking order sector-wise, even though I was telling Prashant it'll be more stock-specific, will probably be Pharma 1, Cement 2, Auto Anks 3, and Banks 4. I think if I was to make a portfolio for the next 1 year, that is probably where the bulk of my allocation would be. And I think within that, at least a third to 40% of my exposure would be in pharma. And then you could probably have the remaining 60% divided equally amongst the other sectors. Cement is a very big play because you're 1 year away from a general election when you get into the calendar. So I think government spending on infra projects and others is going to be quite material. So as a second order beneficiary, cement, I think, will end up doing pretty well. And, if you do have a little bit of rural spending, then therefore I said maybe auto anks, specifically at the bottom end of the pyramid. I think those could be reasonable sectoral plays to take a look at.
Hey, hi Rahul, morning. Good to have you in studio. I remember years ago I used to look at you in studio, and in fact, we've had good times as well over the last decade or so. But let's probe you more on that point. Pharma, could you give us a couple of names? Since that's been a big underperforming sector actually. If I look at it from say 2015-16 till date. The index hasn't done much. Stocks have done their own thing. Any particular stocks you're looking at? And also from the auto ancillary names, if you could give us a couple of names.
Sure. So I think, Nigel, if you look at the next 5 years, I think you have about $140 billion worth of branded generics that are going off patent in the United States. Unfortunately, a lot of these are very high competition drugs. So you're going to get into a very high pricing erosion kind of a scenario. So within pharma, I think unless you have a very strong R&D portfolio, something like what a Sun Pharma has, I'd probably stay away from US-tilted pharmaceutical stocks. I think Sun has got a good blend of both US as well as India. Yes. So I think that would probably be one name that we would definitely play. The other would be Cipla. I think Cipla has got a very large domestic play. I think even if you look at US, right, almost 28% of the US business comes from a relatively low competition respiratory segment. Even in India, I think 22% of their exposure is to respiratory, which is not a very high competition space. And even if you look at the global markets, I think Albuterol has done pretty well for them. I think, at our broking firm, we're projecting about a 16-17% earnings CAGR over the next 2-3 years. Coming to you at 20 times, I think that's a reasonable bet. So I think in pharma, stick with the larger names. I think Cipla and Sun would be the better names to have. In autos, I think I was hearing Sonia talk about tires. That may not be a bad theme, but we're still relatively positive on commercial vehicles. So we'd still probably pay Ashok Leyland from the OEMs. Okay. As a proxy, I'd probably look at something like a Jamna Auto. I mean, it's got a 30-35% return on equity and capital employed. Very strong margins if you compare them to other auto anchors, and coming to you at just about 21-22 times. I think for the kind of return ratio profile and the balance sheet strength, not too much leverage. They're a market leader in parabolic springs, and they've now recently started supplying to Tata Motors as well. So they've got a good, strong order book. I think if Europe was to sort itself out, a slightly longer term play, because it's in a bit of a mess right now, I think Endurance could make a comeback. I think it's unfortunately been a rank underperformer, obviously because of its exposure to Europe. But I think the business is good. And maybe on corrections, Sona, which is again a very, very high valuation stock. You know, that's what happens sometimes, I think, in sectors which are very highly concentrated. Institutional investors tend to pick up just a few stocks. And because of the liquidity that's coming in, the PE ratios just keep expanding. So I think maybe Jamna, a couple of the tire names that were discussed, and something like a Sona or an Endurance.
What about TVS? I know it's rallied a lot, but it's still, compared to its 5-year average, it's not bad. I mean, it's trading at 28 times forward. The 5-year is about 28, 29 times itself. Do you think there's still valuation headroom there?
I don't know about valuation headroom, but I think they're delivered better than the other two peers for sure. I think they've been ahead of the game in premiumizations in EVs. Hero, of course, just recently had an EV launch. I think... you know, Sonia, I think the big thing about TVS has been how long can they sustain their double-digit margins, right? To get to 10-11% and sustain them over a period of time. Whereas you had the other two that have actually managed to sustain that and do that quite effectively. I think if I was to look at it from a preference standpoint, Sonia, I think Hero would probably be a slightly more, you know, value additive pick for us because of the valuation comfort and the cash on books. And I think finally that they've delivered on the EV. I think the dividend yield on Hero is also reasonably good. So I think it's not so much that we don't like TVS. I think it's going back to the point that I was making with Prashant. I think it's about finding value. So on a relative basis between TVS and I could throw in a Bajaj, but then a Bajaj has a very large export contingent as well, and then of course a very large contingent of that to the African continent. So I think it's safer to stay with players that are home and at a good value. I think TVS has had a remarkable run that you said. I think Hero would probably be a better pick for us between the two.
Rahul, just to go back to that broader point that next year is going to be largely tough and ranged. Where does that leave us in terms of sort of trying to get exposure to stocks? Wait for dips. You will get opportunities along the way. Don't have to chase stocks higher. That's the broad way to think about the market with that view.
I would think so, Prashant. I mean, if you allow me a slightly long-winded answer, I mean, if we go back to the textbooks and look at the formula for GDP, right? It's C plus I plus G plus X minus M. As we were discussing, the X is not in your control because you're going to have a global slowdown. And unfortunately for us, our rupee is depreciating and we're an importer of commodities. So I don't think the X and M is by and large in your control. You're left with CI and G. I think as far as investments are concerned, Prashant, the one good thing COVID has done is it's helped corporate India delever its balance sheets in a very dramatic way. Cash flows are at all-time highs. As per RBI data, I think utilization levels are at 70-75%. A lot of the capex, I think, across sectors has already been announced, and you are in a rising interest rate environment. So I don't think incremental capex announcements are going to be very serious from here. And then you're down to CNG. Now, the problem with CNG, and I look at consumption very closely, is that there is a twofold impact that you're seeing in consumption. One is you had no expenditure for almost 15 months and people came and consumed, and too much easy money was made in the stock markets. I think this wealth effect is going to wane off. I don't think you're going to have the same wealth effect next year. So you're not going to see the same ferocity of consumption sustained. So you're effectively down to G, which is government spending, and it coincides with a slowdown, but it coincides with an election. Therefore, the point I was making about cement and otherwise. So I think while traditionally markets are going to go up over a longer period of time, I would think in a rising interest rate environment, it may not be imprudent to start looking at some other asset classes, whether it's fixed income.
Fixed income gets more competitive.
Absolutely.
Yeah, absolutely.
You just see, we're not in an era where FD rates are at 8-9%. If they were, my sense is you would have seen mutual fund redemptions by now. The fact that fixed deposit rates are not there, and there is not too much of a, the TINA factor, as they say, there's not too much alternate asset class competition to equities right now. But if you get into a slowdown or a recessionary environment next year, I don't see why flows cannot enter fixed income, maybe gold and silver in some material way. Or, I've been hearing Deepak Parekh on your channel talk about the bullishness in real estate. I think that could potentially still sustain. I think there's still some demand out there. So maybe if you have a one-year view, if you were, say, 60-70% kind of equity market investor, I'd probably trim that down to about 50% and look at 50 for the other half. I think the time will come. There is no doubt that the Nifty will head to 20, 25, 30,000 over a period of time. Yep. We never thought we'd be here at 7,500 Nifty, but I think it's slightly, I think the bigger call, and I'm very happy you raise it. It's as important to look at asset allocation than it is just to look at stocks. But I'd be okay with the 50% equity allocation. I think anything more than that, at this juncture, looking ahead from the current evidence that we have could be a little tricky.
You know, Rahul, normally when you join us, you talk about the QSR space as well. You know, some of those themes out there that have done pretty well. Westlife is something I think that you all have got bang on for the last so many years. What do you do with that stock now? I think it's hit fresh all-time highs. And just a quick word on the real estate point you were making. You'll be more positive on physical real estate, or do you think via the stock market as well, you'll look to play those themes either directly or indirectly?
So let me shock you with my answer. I'd say if you're an investor in Indian hotels and Westlife, with two stocks we pushed really hard, and I hope my team doesn't hold me to this, I think it's good time to take profits off, is my sense. We've been very bullish, as you said, but Indian Hotels has gone from 70 to 350. McDonald's has gone from 250 to 750. You know, as Gordon Gekko once said, don't get emotional about stock. Everything at a price.
That's not a shocking answer. I mean, that is the most prudent thing to do, right?
Yeah, I think, but you know, I'll tell you the interesting part, Nigel, that you ask. This is a very interesting quarter because this weekend you have the T20 World Cup starting, and as soon as it ends, you have the FIFA World Cup starting. It's not unusual you have two global sports in one quarter. So I think for this quarter, it will still be good. It may not be imprudent, even though I don't track the stock, to play second-order beneficiaries. I wouldn't be surprised if Zomato has its best quarter on record this quarter. Even though we don't track it, because you have two global sporting events, I wouldn't be surprised if Zomato made a play to 90 or 100 by the end of the quarter. I think this could be a quarter that holds up pretty well for them. So I think just for this quarter, maybe you can look at booking profits at the end. On real estate, probably more, I'd say, looking at the slowdown scenario, I think commercial and retail will probably take a step back. I would look at residential, but I think, Nigel, probably just because of my sort of caution on the markets, I'd look to play through REITs.
Okay.
I wouldn't play it directly. I'd play through Mindspace or I'd play through Embassy because I'm assured of my units, I'm assured of my dividend, and I think that's slightly a more prudent way to play it with the asset owners, I think, rather than playing it a physical asset directly. So if you were to play it, I'd say play it through residential, names like Prestige, Brigade, Shobha, the likes, but I think the slightly more prudent way, looking at it as an asset class, to answer Prashant's question, REIT is an asset class, effectively. Right. So I could potentially look at playing it through REITs.
Rahul, very quickly, if you could tell us who's the favorites for both the World Cups?
Ooh. I'm going to go a bit controversial here, and I'm going to say because of the Asia Cup, I'm going to say probably Sri Lanka for the 2020 World Cup, because I think that country is in so much of a mess, and I saw what, you know, we were very young when we saw what Imran Khan did with the 1992 World Cup, and the country needed something, some positivity. I think there's so much wrong that's happened. I think that's there. Football, I don't know. Messi's already gone on record saying this is going to be his last World Cup, so I don't know. The man may just come out like you've never seen, you know. I hope it's not a Roger Federer kind of ending. I mean, we've all grown up, you know, watching Roger Federer and idolizing. But I'd love to see Argentina in the finals, at least just for Messi's sake. But I think that's going to be one hell of an event. I think the fact that Qatar is hosting it, it's coming so close to home. It's going to be a little tough to call, but I think my money's probably on Sri Lanka on the 2020.
Well, all of our idols are retiring one after the other, right?
Djokovic is still playing.
All of us growing old together.
I'm a sworn Djokovic fan, and it's really disappointing to see that he's missed out on so many Grand Slams because of the vaccine. But but I think the joy that all three of them have provided, Federer, Nadal, and Djokovic, I think in our lifetimes you probably never get a travel.
Oh, absolutely, absolutely. Okay, one final question, because we're heading into the discussion next. We're doing a discussion on insurance. This is a vast space. So anything in this space that you like for the longer term?
We've loved this space, Sonia. I think the good part is that the leader has given you time to consolidate your holdings, because the valuation gap between HDFC Life and the other three had become so stark. And I think looking at the kind of numbers that are coming through on the AP new business premium, just the growth of the sector, I think SBI Life Insurance and Max Life are still coming to you at reasonable valuations. I think SBI Life and Max are both coming to you at about 18 to 20, between 16 and 20 return on embedded value and return on equity. The VNB margins, I think, for Max Life are a little higher because they're a little more skewed towards protection as opposed to SBI Life, which has slightly more ULIP tilt. But we're slightly more prone towards life insurance companies as opposed to general.
Okay.
In the large cap space, we'll play through SBI Life. In the mid cap space, we'll play through Max Life Insurance.
Okay, thanks a lot for joining us, Rahul. And from the entire team, I mean, happy Diwali to you.
Diwali, Rahul.
To you, your
And
team.
I hope you're flying to Qatar for the World Cup, or
That's a big one.
Well,
representative for.
you know, I do have an Australian visa right now, but I'll see if we probably get that. But thank you so much for having me, and wish you, your team, your families also a very, very happy Diwali. And I must tell you, Prashant's better half and I have had a very long working relationship in another life as well, where we work together.
Absolutely.
But yeah, to all of you and your families, a very, very happy Diwali from us.
Thanks so much. Thank
Pleasure.
you, Rahul. Thanks for dropping by. Well, the market is up 70.